Imagine you're sitting in your living room right now, scrolling through Zillow, watching your home's estimated value tick upward month after month. You feel wealthy. You feel smart. You bought at the right time. Your neighbors are selling for $50,000 more than you paid just 3 years ago. The real estate agent says it's a seller's market. The mortgage broker says rates might go up, so refinance now. Every expert on television says the same thing. Housing always goes up. You believe them. Why wouldn't you? Then one morning you wake up and check Zillow again, but this time something's different. Your neighbor's house, the one that would have sold in 3 days last year, has been sitting for 90 days. Another house down the street just dropped its price by $30,000. Then another. Then yours. You tell yourself it's temporary. It's just a correction. The experts said so, but deep in your gut you feel it. The market isn't correcting, it's freezing. Inventory is piling up, buyers have vanished, and you suddenly realize you're not wealthy anymore. You're trapped. This exact scenario has happened twice before in American history. 1929, 2008. Both times, millions of people watched their wealth evaporate because they didn't understand one critical truth. Housing crashes don't follow a straight line down. They follow a 6-stage pattern. And the most dangerous part? The bubble doesn't pop in stage 6 when prices collapse. It pops in stage 5 when the market locks up and nobody can sell. By the time you see prices falling, it's already too late. Right now, in 2025, every single warning sign from stage 5 is flashing red. And if you don't know which stage you're in, you won't see what's coming until your equity is gone. You're watching the housing market in 2025, and if you know what to look for, you're seeing something terrifying. Inventory has been rising for 20 straight months. Sellers outnumber buyers by 500,000. Homes are sitting on the market longer. Price growth has slowed to 0.8% annually. The experts on cable news call it just a correction. They say the fundamentals are strong. They say this time is different. But here's what they're not telling you. You've seen this exact pattern before, twice, and both times it ended in catastrophe. Let's go back to 1929. Manhattan real estate prices peaked in the third quarter of that year, then fell 67% by the end of 1932. Between 1928 and 1933, home prices nationwide declined 25.9%. By 1933, 40 to 50% of all mortgages in America were in default. 40 to 50%. Think about that number. Nearly half of everyone who owned a home couldn't pay their mortgage. But here's the part they don't teach you in school. The crash didn't start when prices fell. It started when nobody could sell. The market froze first. Prices collapsed second. Now fast forward to 2008. Housing peaked in mid-2006. Prices fell 27.4% from peak to trough between 2006 and 2012. Some areas saw declines over 50%. Arizona, California, Florida, Nevada. Entire neighborhoods went underwater. In 2008 alone, there were 2.3 million foreclosure proceedings, an 81% increase from 2007. By September 2009, 14.4% of all mortgages were either delinquent or in foreclosure. $11 trillion in household wealth vanished. But again, the crash didn't start with falling prices. It started in 2007 when sales volumes collapsed, inventory flooded the market, and sellers realized they were trapped. The freeze came first. The price crash came later. Both crashes followed the exact same pattern, a 6-stage cycle that plays out with disturbing precision. Stage 1 is recovery, when rates drop and genuine buyers cautiously return. Stage 2 is expansion, when fundamentals actually support price growth and wages can cover mortgages. Stage 3 is acceleration, when speculation enters and price-to-income ratios start stretching beyond what's sustainable. Stage 4 is euphoria, when everyone believes it's different this time and the final wave of buyers rushes in at the worst possible moment. Stage 5 is the pop, but not the way you think. This is where the bubble actually bursts, not when prices crash, but when the market locks up. When inventory floods. When sales die. When nobody can sell. And stage 6 is the cascade, when prices finally collapse and foreclosures wave through the system and the carnage becomes visible to everyone. The most dangerous part of this entire cycle is that stage 5 is invisible to most people. You can't see it on the evening news. Your neighbor's house still shows a high Zillow estimate. The bank still says your equity is intact. But underneath, The market has already frozen, and if you don't understand which stage you're in right now, you won't see stage 6 coming until it's already too late. The question isn't whether this pattern repeats. The question is whether you'll recognize it before your equity disappears. Let's walk through the first 3 stages so you understand exactly how this cycle builds. Stage 1 is recovery, the foundation that gets laid after every crash. After the devastation, rates drop, construction returns slowly, and genuine buyers enter the market cautiously. This is what happened in the 1930s after the Federal Housing Act of 1934 created the FHA. They introduced new 15-year fully amortizing mortgages that replaced the risky 5-year balloon loans that had caused the '29 crash. The market stabilized. People could actually pay off their homes instead of facing a massive balloon payment they couldn't afford. Then look at 2009 to 2012. The Fed dropped rates to 0 to 0.25%. Foreclosures peaked at 2.8 million in 2009. By 2012, the bottom was finally reached with that 27.4% price decline. This is stage 1. It's painful, but it's necessary. It clears out the excess and resets the market to reality. Stage 2 is expansion, and this is what healthy growth actually looks like. Fundamentals drive prices, wages support mortgages, price-to-income ratios remain reasonable. This is the stage where buying a home makes sense, where a working family can afford a mortgage without destroying their budget. In the 1920s, from 1922 to 1925, construction rebounded after the post-World War I recession. The median home price was around $18,000, equivalent to roughly $175,000 today when adjusted for inflation. Working-class families could afford bungalows at $1,500 to $5,000. People were building wealth, not speculating. From 2012 to 2016, we saw the same thing. Lending standards were strict after the crisis. Prices rose steadily but sustainably. The recovery was building on solid footing. If the cycle stopped here, we wouldn't have crashes, but it never stops here. Stage 3 is acceleration, and this is where things start to stretch. Speculation enters the market. Investors pile in looking for returns. Price-to-income ratios start extending beyond what fundamentals support. Media coverage intensifies. The psychology shifts from, "I need a place to live," to "I don't want to miss out." Look at the mid-1920s. The Florida real estate bubble from 1925 to 26 saw Miami lots bought and sold 10 times in a single day. Nationwide, home values and home ownership surged dramatically across the decade. Everyone wanted in. Then, from 2004 to 2006, home values surged 127%, from 1997 to 2006. Subprime mortgages proliferated across the market. By October 2007, 16% of subprime adjustable rate mortgages were 90-plus days delinquent, triple the rate from 2005. But prices were still climbing, so everyone assumed it was fine. This is where you need to pay attention to the indicators. Price-to-rent ratios diverge from fundamentals. Price-to-income ratios exceed historical norms. Investor purchases surge beyond actual owner-occupant demand. Construction accelerates beyond what population growth can support. These are the warning signs that Stage 3 is transitioning to Stage 4. And Stage 4 is where the real danger begins, because that's where euphoria takes over and the final wave of buyers rushes in at the absolute worst moment possible. Stage 4 is the euphoria trap, and this is where everyone believes it's different this time, where experts declare housing only goes up, where the final buyers rush in at the worst possible moment and lock in losses they won't realize for years. In the third quarter of 1929, Manhattan prices hit all-time highs. 46% of Americans were homeowners by 1920, up dramatically from previous decades. New suburbs exploded around every major city. Everyone wanted in on the boom. If you bought a typical property in 1920, it would retain only 56% of its value in nominal terms 2 decades later. But in late 29, nobody was thinking about 20 years from now. They were thinking about getting in before prices went even higher. Mid-2006 saw the same insanity. The National Association of Realtors' chief economist was distributing anti-bubble reports to counter what he called irresponsible bubble accusations. The median home hit $226,000, up from under $200,000 just years before. The chief economist of Freddie Mac publicly disputed the existence of a national housing bubble. citing decades of steady price increases as proof that everything was fine. These weren't random people on the internet. These were the supposed experts, the people with access to all the data, telling Americans that housing was a safe investment at the absolute peak. The psychology at this stage is always identical. They're not making any more land. Interest rates will stay low forever. Housing always recovers. This time is different. You hear these exact phrases repeated by real estate agents, mortgage brokers, financial advisors, and cable news talking heads. And people believe it because they want to believe it, because their neighbours are making money, because waiting feels like losing. Then we get to 2020 through 2022, and the modern euphoria makes 2006 look restrained. The pandemic triggers the biggest housing boom since 2006. Prices increase 1 to 2% per month for 24 straight months from May 2020 to May 2022. Home values surge 127% in some markets. Bidding wars become standard across the country. Cash offers above asking price become the norm. If you weren't offering $20,000 over asking with waived inspections and appraisal gaps, you weren't getting the house. People were buying homes sight unseen in Zoom calls. This was peak insanity. But even in the midst of euphoria, the warning signs appear for anyone paying attention. In 2021, the Dallas Fed issued a warning about a brewing US housing bubble, visible in price-to-rent and price-to-income ratios showing prices increasingly out of step with fundamentals. But the media largely ignored it. Buyers ignored it. Everyone was too busy trying to get in before they were priced out forever. By June 2022, the peak was in. Mortgage rates started climbing. The Fed began raising rates to fight inflation. And what came next was stage 5, the invisible stage where the bubble actually pops but most people don't realize it yet. This is the stage that destroys fortunes before the headlines ever catch up to reality. Stage 5 is where the bubble actually pops, but not in the way most people think. Prices haven't crashed yet. The headlines aren't screaming crisis. Your Zillow estimate might even still look decent, but underneath, the market has frozen. Nobody can sell. Inventory floods the system. Sales volumes die. This is the invisible stage that destroys fortunes before anyone realizes what's happening. In 1926, the Florida bubble deflated. Construction nationwide began slowing. By 1929, building permits in cities that had peaked from 24 to 26 showed pronounced decline. The housing market downturn in 26 led directly to a rise in the foreclosure rate, but the stock market was still climbing, so nobody connected the dots. Then came the freeze. The stock market crashed in October 1929. Suddenly nobody could sell their home. The wealthy couldn't liquidate real estate to cover margin calls. The middle class couldn't find buyers. Foreclosures began rising. The market locked up completely. This wasn't the crash. This was the pop. The crash would come later in stage 6. 2007 brought the second lock. There were 1.3 million foreclosure proceedings that year, a 79% increase over 2006. By January 2008, the inventory of unsold new homes was 9.8 times the December 2007 sales volume, the highest value since 1981. By May 2008, 25% of subprime adjustable rate mortgages were delinquent. In August 2008, 9.2% of all US mortgages were either delinquent or in foreclosure. Sales dropped 26.4% in 2007 compared to the preceding year. Nearly 4 million existing homes were listed for sale. 2.2 million sat vacant. The bubble had already popped. Prices just hadn't fallen yet because sellers were still in denial, still listing at peak values, still believing buyers would return. The Fed raised rates in June 2022, and that was the trigger for the third lock. Mortgage rates doubled from 3% to 6 to 7%. Sales collapsed to the lowest levels in almost 30 years. Look at the current data. October 2024 saw 3.96 million existing home sales on an annualized basis, near 30-year lows. May 2025 shows 2,058,065 homes listed, up 14.1% year over year. That's 20 straight months of inventory. Growth through June 2025. Sellers outnumber buyers by 500,000 according to Redfin in 2025. New home inventory hit 481,000. The highest since 2007. Speculative inventory reached 385,000, the highest since 2008. Here's the critical insight most people miss. Price growth is slowing to a crawl. May 2025 median was $441,526, up only 0.8% year over year. That's down from 4.5% growth in 2024. Some markets are now showing year-over-year price declines. Florida negative 0.13%, Texas negative 0.59%. 53% of US homes lost value over the past year, the highest percentage since 2012 according to Zillow. The pop has happened. The market has frozen. Most people just don't know it yet because they're still looking at their outdated Zillow estimates and believing the experts who keep saying it's just a correction. Stage 6 is the cascade, and this is what comes after the pop. This is when the freeze of Stage 5 becomes the catastrophe that everyone can see. By the end of 1932, Manhattan prices were down 67% from their peak. National home prices fell 25.9% between 1928 and 33. 40 to 50% of mortgages were in default by 1933. Thousands of foreclosures flooded the market every single month. Banks were failing. Homeowners were walking away. The crash that started in Stage 5 during the 26 to 29 freeze finally showed its full devastation. Families who bought at the peak in 29 lost everything. The American dream became a nightmare that lasted a decade. 2008 through 2012 brought the second cascade. Prices fell 20% by September 2008, then 27.4% peak to trough by 2012. Over 6 million households lost their homes to foreclosure. $11 trillion in household wealth evaporated. 14.4% of mortgages were delinquent or in foreclosure by September 2009. Unemployment hit 10%. Some areas saw price declines over 50%. Phoenix, Las Vegas, Miami, parts of California, entire neighborhoods went underwater. People who bought in 2005 or 2006 with minimal down payments found themselves owing $200,000 on homes worth $120,000. They had two choices: keep paying a mortgage that made no financial sense, or walk away and destroy their credit for 7 years. Millions chose to walk away. The freeze of Stage 5 in 2007 and early 2008 became the catastrophe of Stage 6 from 2008 to 2011. So where are we now in late 2024 and early 2025? The evidence suggests we're in late Stage 4 transitioning into Stage 5. The Stage 5 indicators are already present and flashing red. Inventory has been surging for 20 straight months. Sales are at near 30-year lows. Sellers outnumber buyers by 500,000. Price growth has slowed to 0.8% year over year. 53% of homes are losing value. New inventory is at 2007 to 2008 levels. Speculative inventory matches 2008 peaks. Mortgage rates sitting at 6 to 7% have crushed demand. These are not normal market conditions. These are Stage 5 conditions. But the Stage 6 indicators aren't present yet. We're not seeing major price collapses, just minor declines in Florida and Texas. We're not seeing mass foreclosures because they're still historically low. We're not seeing an unemployment surge since it's still under 5%. We're not seeing a credit crisis because lending standards have remained tight since 2008. Stage 5 can last anywhere from 6 to 24 months. The 1926 to 29 freeze lasted 3 years. The 2007 to 2008 freeze lasted 12 to 18 months. If we entered Stage 5 in mid-2024, Stage 6 could arrive anywhere from 2025 to 2026. Here's what you need to understand about timing. Stage 5 is the warning. Stage 6 is the execution. Right now, you're in the warning phase. The market has frozen. Sellers can't sell. Buyers have vanished. Inventory is piling up. But prices haven't collapsed yet because sellers are still in denial. They're still listing at 2022 values. They're still waiting for buyers to return. They will not return. Not at these prices. Not at these rates. What comes next is the cascade.